The IRS just dropped a bomb for 2026 retirement that nobody's talking about. And if you miss this, you're literally throwing away up to $24,000 as an individual, or nearly $47,000 as a couple. Yes, you heard that right, $47,000. But here's the problem. These deductions vanish at certain income levels, and there are hidden traps that could end up costing you more than you save. Let me tell you about a 72-year-old retired teacher I worked with recently. Smart guy, thought he had everything figured out. He knew about the $6,000 bonus, he was excited, but he made one mistake, one single error, and it cost him over $4,000 plus triggered a Medicare penalty that's still bleeding him $300 every month. What went wrong? I'm revealing his exact mistake at the 6-minute mark. If you need to, write down that timestamp, because I guarantee some of you are making this same error. Right now. Stay with me because I'm breaking down the exact numbers you need before tax season starts January 26th. That's days away. This is George from Dream Visa Updates. Tell me your age and where you're watching from in the comments. I break down complex tax and financial topics into strategies you can actually use. No jargon, no fluff, just real money-saving information. Today's topic could be the difference between keeping thousands in your pocket or handing it to the IRS. The One Big Beautiful Bill Act has completely changed the game for seniors in 2026. Most people think taxes go down in retirement. With these new brackets and deductions, the rules have flipped. Here's the truth nobody talks about. Financial stress in retirement rarely comes from market returns. It comes from misunderstanding taxes, income planning, and timing. If you're 65 or older or planning for retirement, you're exactly where you need to be. Let me tell you about Robert, the client I mentioned. 72 years old, retired teacher, solid pension, good Social Security. The kind of guy who does his homework and plans ahead. In 2024, Robert did something his financial advisor recommended. It wasn't a bad move on paper, it made perfect sense. He was trying to be smart with his retirement money. Fast forward to 2026. Robert opens his Medicare statement and nearly falls out of his chair. His monthly premium had jumped from $174 to almost $480. That's an extra $300 every single month, $3,600 a year, just gone. And here's the worst part. Nobody told him it was preventable. Nobody told him about the one form he could have filed to stop it. What did Robert do? I'm telling you his exact mistake in a few minutes. But first, you need to understand these new deductions because that's where his problem started. Once you see what he did wrong, you'll understand why I'm so passionate about getting this information out there. Let's start with the big news, what I'm calling the senior bonus. First, here are the new baseline standard deductions for 2026. Look at your screen. Single filers get $16,100. Married filing jointly gets $32,200. Head of household gets $24,150. Write those down. These are up from previous years. But here's where it gets interesting, and this is where most people miss out on thousands. Are you 65 or older? Or will you turn 65 by December 31st, 2025? If yes, the next 60 seconds could put thousands of extra dollars in your pocket. There's a brand new senior bonus deduction. If you're 65 or older by the end of 2025, that's the tax year we're filing for in 2026, you get an extra $6,000 deduction. And if both spouses are 65 or older, that's $12,000 straight off your taxable income. But wait, this isn't the only deduction seniors get. This new bonus actually stacks on top of other deductions you already qualified for. Let me show you how this adds up. Look at the screen right now, because these numbers stack up fast. For a married couple where both spouses are 65 or older, here's what you get. First layer, standard deduction for married filing jointly, $32,200. That's your foundation. Second layer, additional age deduction that's been around for years. $1,650 per qualifying spouse, so that's $3,300 total. Third layer, the new senior bonus deduction, $6,000 per person, so $12,000 total. Add it all up. $32,200 plus $3,300 plus $12,000 equals $47,500. That's nearly $50,000 of your income completely protected from federal taxes. Think about that. If you're a married couple bringing in $90,000 a year in retirement, $47,500 of it is completely tax-free. You're only paying taxes on about $42,000. If you're single and 65 or older, here's your stack. Standard deduction $1,600, additional age deduction $2,150, new senior bonus $6,000, total shield $24,150. If you're single and living on $50,000 a year, less than half of it is even taxable. This is real money. But before you get excited, I need to tell you about the trap. This is critical. Here's where thousands of dollars can disappear if you're not paying attention. And this is exactly what started Robert's problems. Remember him? We're getting close to revealing what he did wrong. These bonuses phase out. If you make over $75,000 as a single filer or $150,000 as a couple, the IRS starts taking that bonus back. Here's exactly how it works. For every $1,000 you earn over the threshold, you lose $60 of the bonus deduction. Every $1,000 over equals $60 lost. And once you hit $175,000 as single or $250,000 filing jointly, the bonus is completely gone. You'll still get the standard deduction and the age deduction, but that powerful $6,000 or $12,000 bonus vanished. Also important, you must file as single, head of household, surviving spouse, or married filing jointly. Married filing separately does not qualify. That's a hard rule. Let me show you how this phase out works with a real example, because this is where people get caught off guard. Meet Jane. She's 67, single, doing well in retirement. Pension, Social Security, took a little from her IRA this year. Her total income, $80,000. The phase-out threshold, $75,000. She's over by $5,000. Remember the rule. For every $1,000 over the limit, you lose $60 of the bonus deduction. So Jane loses $5 times $60. That's $300 of her $6,000 bonus. You might be thinking, okay, $300, not the end of the world, right? Wrong. And here's why. That $300 reduction triggers what I call the domino effect. When your taxable income goes up by even a small amount, watch what happens. It can push you into a higher tax bracket. It increases how much of your Social Security gets taxed. Up to 85% can be taxable. And here's the big one. It triggers higher Medicare premiums through something called IRMAA. So that seemingly small $300 loss could actually cost you $1,000 or more when you add up all the cascading effects. This is exactly what happened to Robert. Let me show you the flip side first, because this proves that smart planning pays off. Jane's neighbor, Margaret, is also 67 and single, but Margaret's income is $73,000. She's under the threshold by $2,000. Margaret gets the full $6,000 bonus deduction, full amount. Same age, same situation, living next door to each other. But Margaret is going to pay significantly less in taxes simply because she managed her income strategically. Maybe she delayed a small IRA distribution until next year. Maybe she timed the sale of some stocks differently. Small moves, massive difference. And here's something that sounds backwards, but is absolutely true. Sometimes making $2,000 less in a given year can actually leave you with more money in your pocket after taxes and Medicare premiums. The math doesn't lie. We're at the 6-minute mark. Remember when I told you I'd reveal Robert's mistake? Here it comes. Pay very close attention because this could save you thousands. Let's talk about Social Security quickly because you need to understand this before I tell you what Robert did wrong. The rules for taxing Social Security haven't changed. Up to 85% of your benefits can be taxed depending on your income. Most people assume Social Security is tax-free. It's not. But here's the good news. In 2026, that new senior bonus actually acts as a protective shield. When you take that $6,000 or $12,000 bonus deduction, it lowers your taxable income. And lower taxable income means less of your Social Security gets taxed. But remember Jane? When she lost $300 of her bonus deduction because she was over the income limit, it didn't just increase her regular taxable income. It also increased how much of her Social Security became taxable. This is the washout effect. For married couples filing jointly, let me give you your complete picture. Standard deduction, $32,200. Age deduction for both 65 plus, $3,300. Senior bonus for both 65 plus, $12,000. Total $47,500. That's a massive shield protecting your Social Security and other retirement income from taxes. But stay over $150,000 and you start losing it. Hit $250,000 and the bonus is gone. Entirely, some of you are thinking, this is great, but I'm already over those limits. Does this even matter to me? Yes, because there are strategies to manage your income. But first, the trap that caught Robert. This is what happened to Robert. And if you've made any big financial moves in the last 2 years, you need to hear this. This next part is the trap that catches almost everyone off guard. It's called IRMAA, Income-Related Monthly Adjustment Amount, and it can literally double your Medicare premiums overnight. This is what destroyed Robert's retirement budget. Robert retired in 2023. Great pension, solid Social Security, some savings. He was set. In 2024, he decided to do a Roth conversion. His financial advisor told him it was a smart move, and honestly, it wasn't bad advice. Roth conversions can be brilliant for the right person at the right time. He converted $120,000 from his traditional IRA to a Roth. Tax-wise, he paid the bill that year. He wrote the check, thought everything was fine. Case closed. That was his mistake. Fast forward to 2026. Robert gets his Medicare premium notice in the mail. He opens it and nearly falls out of his chair. His monthly premium had jumped from $174 to almost $480. That's an extra $300 a month, $3,600 a year, just in Medicare premiums for the exact same coverage. You're probably wondering, how does a Roth conversion in 2024 affect Medicare premiums in 2026? Here's the trap. Medicare uses a 2-year look back to determine your premiums. That means for your 2026 Medicare premiums, the IRS is looking at your 2024 tax return 2 years ago. Robert's Roth conversion in 2024 pushed his income way up that year, even though his income in 2026 was back to normal, back to just his pension and Social Security. Medicare didn't care. They saw that spike 2 years ago, and boom, IRMAA, surcharges. Here's the part that really frustrated Robert and makes me angry on behalf of clients like him. Nobody told him about Form SSA 44. This is the form you file to appeal your IRMAA charges if you've had a life-changing event or income reduction. Robert could have filed this form, explained that the 2024 income was a one-time event from a Roth conversion, and potentially gotten those surcharges reduced or eliminated. But he didn't know about it. His advisor never mentioned it. The Medicare notice didn't explain it clearly, so he just paid the higher premiums for months, bleeding $300 monthly before someone finally told him. By the time he found out, he'd already paid over $2,000 in unnecessary premiums. Here's the lesson. Did you sell a property in 2024? Convert a large IRA to Roth? Take a big distribution? Receive an inheritance that created taxable income? Sell a business? Cash out stock options? Even if your income is much lower now in 2026, you could be hit with IRMAA surcharges that can add hundreds of dollars per month to your Medicare costs. And here's the kicker most people don't realize. Most people just pay the bill without realizing they can appeal it. They think it's automatic. They think there's nothing they can do. They're wrong. If you're already retired, lost a spouse, or had a significant income reduction, you do not have to just accept these higher premiums. You need to file Form SSA 44 immediately. This form tells Social Security that your income has dropped and they can lower your premiums retroactively. Retroactively means they'll give you back money for the months you overpaid. This is one of those things that can save you thousands of dollars a year, but most people have never heard of it. After I told Robert about Form SSA 44, he filed it immediately. He provided documentation showing his 2024 Roth conversion was a one-time event. Within 6 weeks, Medicare adjusted his premiums back down. He's now saving over $3,000 a year. That's $3,000 staying in his pocket instead of going to Medicare unnecessarily. The bottom line, that one-time income spike from 2 years ago could be costing you money right now, even though your current income is much lower. Check your Medicare premiums, look at your statements, and don't be afraid to appeal. Listen, we're about halfway through this video. If you're still with me, that tells me you're serious about protecting your retirement money. The next few minutes are going to give you the exact action steps to make sure you don't make Robert's mistake. Stick with me. Let's talk about the mechanics. Some of you are probably wondering, this sounds great, but how do I actually claim this senior bonus deduction? Good news, it's automatic. The IRS made this one easy. You'll file using Form 1040 or Form 1040 SR, which is specifically designed for seniors. When you fill out your tax return, you simply enter your date of birth. That's it. If you're 65 or older by December 31st, 2025, the IRS will automatically calculate your eligibility for both the age deduction and the new senior bonus. If you're using tax software, TurboTax, H&R Block, Free Tax USA, or any reputable program, it should automatically flag your eligibility and apply all the deductions for you when you enter your birth date. The software does the math. You just need to make sure your birth date is correct. If you're filing a paper return, make sure you check the age 65 or older box. Don't skip this. Include accurate Social Security, numbers for you and your spouse if filing jointly. And make sure your birth date is clearly written. Remember, you don't need to itemize to get this deduction. Whether you take the standard deduction or itemize, you still get this bonus if you're eligible. The deduction will reduce your taxable income, which means you'll either owe less in taxes or get a bigger refund. Speaking of refunds, let's talk timing. Here's the timeline for getting your money. Paper filing, expect your refund in 6 to 8 weeks. That's the slowest option. Electronic filing, you're looking at less than 3 weeks. Electronic filing with direct deposit, you could see your refund even faster, potentially within 10 to 14 days. Bottom line, file electronically with direct deposit if you want your money as quickly as possible. Why wait 2 months when you could have your money in 2 weeks? Here's something really important you need to know, especially if you're watching from certain states. These federal deductions aren't automatically available in every state. According to the Associated Press, states have to decide whether they want to incorporate these federal tax cuts into their own state tax codes. Some states do this automatically, their tax code is linked to the federal code, but other states require official action to implement the changes. You'll want to check with your state's tax authority or a tax professional to confirm whether these deductions apply to your state taxes as well. Here's how to find out. Google your State Department of Revenue 2026 tax changes. Call your state's tax helpline. Ask your tax preparer specifically about this. Don't assume, verify, because you might get the federal deduction but not the state deduction, which means you're still paying state taxes on that. Income. We're coming into the home stretch. The next 4 minutes are your action plan. If you only remember 4 things from this entire video, make it these 4 steps. This is what separates people who save thousands from people who overpay. The 2026 tax changes are here, and proactive planning is no longer optional. This is the difference between keeping your savings and handing them back to the IRS. Let me give you your 4-step action plan. I want you to actually do these things, not just nod along. Number 1, audit your income. Stay under those senior bonus limits if possible. If you're close to $75,000 as a single filer or $150,000 as a couple, you need to consider strategies to keep your income just below those thresholds. Maybe delay an IRA distribution. Maybe time your capital gains differently. Maybe hold off on selling that rental property until next year. Here's a specific example. Let's say you're at $74,000 in income and you're thinking about selling some stock that would give you a $3,000 gain. Stop. Wait until January. Take that gain next year. Why? Because staying under that $75,000 threshold this year saves you way more than that $3,000 gain is worth. You keep your full $6,000 deduction. You avoid the domino effect on Social Security taxation, and you keep your Medicare premiums lower. That $3,000 you gave up actually saved you $5,000 or more in total tax impact. That's strategic thinking. Number 2, defuse the Medicare bomb. This is the Robert situation. Check your 2-year look back right now. Pull out your 2024 tax return. Look at your adjusted gross income. Now compare it to your current 2026 income. If there's a big drop, anything over $20,000, file Form SSA 44 to lower your Medicare premiums. Where do you get Form SSA 44? Google it. Form SSA 44 PDF. Print it, fill it out, mail it in, or take it to your local Social Security office. This alone could save you thousands. Remember Robert? After filing Form SSA 44, providing documentation showing his 2024 Roth conversion was a one-time event, he got his premiums adjusted. He's now saving over $3,000 a year. That's real money. That's a vacation. That's a new roof. That's peace of mind. Number 3, maximize your deductions. Whether you itemize or take the standard deduction, make sure you're getting every dollar you're entitled to. And here's something most people don't think about. If you're close to the itemizing threshold, you can bunch your deductions. What does that mean? Instead of making charitable donations every year, make 2 years' worth of donations in 1 year. Same with medical expenses if you can control the timing. This way you itemize in the high deduction year and take the standard deduction plus your senior bonus in the other year. You're playing the game strategically instead of just letting it happen to you. Number 4, use income shifting strategies. Look into these tools. Roth conversions during lower income years, but do them smart. Don't do what Robert did and convert a huge amount in 1 year without thinking about Medicare implications. Spread it out over multiple years. Convert just enough to stay under the thresholds. Qualified charitable distributions or QCDs. If you're over 70 and a half and you donate to charity, you can send money directly from your IRA to the charity. It doesn't count as income. It satisfies your required minimum distribution and it keeps your AGI lower. Donor-advised funds. These let you make a big charitable contribution in 1 year, get the deduction now, but spread out the actual donations over multiple years. The key is to be strategic. Don't just react. Plan ahead. Think about your income over 3 to 5 years, not just this year. Let me give you a quick summary you can screenshot. Look at your screen right now. I'm going through this slowly so you can capture it. For tax year 2025, filing in 2026, single seniors 65 plus get up to $24,150 in total deductions. Married couples with both 65 plus get up to $47,500 in total deductions. The new bonus deduction is $6,000 per qualifying person. Phase out begins at $75,000 for single, $150,000 for married. Complete phase out happens at $175,000 for single, $250,000 for married. And critical, this bonus expires after tax year 2028. You only have a few years to take advantage of this, so don't wait. Here's something I haven't mentioned yet that creates urgency. Tax season starts January 26th. That's just a few days away. But more importantly, if you're thinking about your 2025 tax strategy, you still have about 11 months before the year ends to make moves. This isn't just about filing your taxes correctly for 2025. It's about positioning yourself right now to maximize these deductions for 2026 and beyond. Check your income projections for 2025. Are you going to be over those thresholds? If so, what can you do between now and December 31st to get under them? That's the conversation you need to have with yourself or your tax advisor this week, not next month, this week. Pull out your income sources, pension, Social Security, IRA distributions, rental income, investment income. Add them up. Where are you landing? Are you close to $75,000 or $150,000? If yes, you have decisions to make. We've covered a lot in the last 20 minutes, but here's what it all comes down to. Taxes in retirement don't have to be complicated, but they do require attention. These new deductions could mean thousands of dollars staying in your pocket instead of going to the IRS, but only if you know about them and plan accordingly. If you found this video helpful, do me a favor. Smash that like button right now. Seriously, hit it. It helps more people find this information. And share this with any seniors in your life who need to know about these changes, your parents, your neighbors, your friends. You could literally be saving someone thousands of dollars. I showed this information to Robert and it changed his entire retirement tax strategy. It could do the same for someone you know. If you haven't subscribed yet, hit that subscribe button and turn on notifications. I put out videos like this every week. Tax strategies, retirement planning, Social Security optimization. This is information that can make you money. Why wouldn't you want more of it? Drop a comment below if you have questions. I read every single one and I'll do my best to point you in the right direction. And if you're dealing with a similar situation to Jane or Robert, let me know in the comments. I might feature your question in an upcoming video. Just remember, I'm giving you information, not personal tax advice. Always consult with a qualified tax professional for your specific situation. Every person's tax situation is unique. Don't forget to check out the description below. I've got links to Form SSA 44 for Medicare appeals, IRS Publication 5554 for seniors, and a checklist for 2026 tax planning. Everything you need is right there. Tax season is here. Make it count. Be proactive. Take control of your retirement income. I wish you a wonderful and tax-efficient 2026. This is George from Dream Visa Updates. I'll see you in the next one.